Good morning, traders. Today is June the 11th. My name is Neville Hornsey, market analyst with YouTrading, and today I'll be looking at a strategy that I'll be using with gold. Okay, looking at the chart, we can see that over the last couple of months, we have been in an uptrend, and that's designated by the higher swing lows and higher swing highs. We've also got three moving averages, the 20, the 50, and the 200 period moving averages on this daily time frame. They are all stacked on top of each other in a bullish manner, and they're all pointing upwards. So there is momentum driving this price action. We've had a pullback to the 20 EMA, and you can see that the 20 and the 50 have acted as support and resistance throughout the last year or so. So currently we're looking for pullbacks towards the moving averages. Yesterday we had one, which is good, and then we had higher prices after the US CPI. So the strategy would be to find a decent entry with low risk. So the idea is to find a spot where you can basically add into a position at or around the moving average, and then to limit your risk by looking at a lower time frame and then just waiting for a new swing high onto the hourly time frame. So here I drew the box. We came down to the daily 20, so as you see here. But on the hourly, you can see that there's this big push down in prices, then a little bounce as traders took profits, and then a further flush just to take out any stops. Then we had a higher high, and then a higher low was formed when that high was broken. So around the 1875 level would have been a good entry, and your risk would have been at the lows here on the hourly chart, which would also have been the daily lows, as you can see on this green candle here. So that's basically how you enter and you follow along with the trend. And to put your stop under a daily low is always a good idea, because if you're wrong, you're going to be pretty wrong all the way down to the 50 EMA. So what else can we look at to sort of see if that's a valid entry level? Well, previously, as the prices run up, you can then put a Fibonacci retracement tool on, and you're looking for a pullback towards the 50 or 61.8% levels. If it does bounce off the 38, before getting to any confluence, either market structure or dynamic moving averages, then that is actually a very bullish signal as well. But for traders looking to get into a sort of a longer term trend, it's normally slower. So a deeper pullback towards the 50 or the 61.8 is ideal. There could be traders looking to get in at this last red candle before the impulsive move up, which would then be confluent with the 76.4 and possibly the 50-day moving average if prices were to collapse, if this is actually a corrective move that we're in now. I'm going to assume that we're not, and I'm going to keep trying to buy the uptrend. And I'm also going to put on a Fibonacci extension tool. So just here, Fibonacci extension. So from the base of the impulsive move to the high, to the low of the current correction, and then you get your sort of measured move up to 1961 and sort of like 50 really, which would be confluent with these two swing highs, like this double top, which is basically where a lot of traders that were bearish will have their stops, and we could get an acceleration through that sort of liquidity level all the way to the 161.8% and above the 2000. So if you're bullish the gold at the moment, then you're looking to get above 2000, and that's one way of being able to do it. If you do get in a trade and say you were at a daily low like around here, then your risk is only going to be like $20, and obviously you're hopefully going to make around 150. Obviously it does keep coming back down and testing, so again you can either maybe be scaling in or pulling your profits, stop losses up, and then capturing some profits, and then just trying again on each dip and then taking profits along the way, so you're mitigating your risk that way as well. But for those traders that are trying to hold on to this trend, just dynamically putting it under a daily swing low is probably a good idea. If I just get rid of this. So on this second entry here, your stop would currently be below this level at 1868. And you'll just have to keep an eye on this current price action here. So, while it has made an impulsive move higher and is pulling back into these lower time frame moving averages, that is obviously a correction of this move. What you don't want to see is then a lower high and then a lower low. You might as well just get out early if you are long around here and your stop's currently there. If you start to see a zigzag down, then you might as well get out before risking all of your money, because there's going to be plenty of other opportunities to get in on the 20 if previous price actions anything to go by. Okay, so that's kind of it. Try and follow the trend. Try and find some confluence between moving averages, market structure, and something like the Fibonacci retracement and extension tools. And you should be able to at least have 2 or 3 sort of confluent ideas which back up your thesis. And the trend is your friend until the bend at the end. If you have made money this week, try and keep it and go into the weekend happy, and then start the next week all good and relaxed. All right, take care.